Hey, here's my video project for circular flow. Okay, so the first thing that we need to know is what a product market is. So a product market is basically any place where businesses can sell goods and services. Now the next thing that we need to know is what a resource market is, also known as a factor market. A resource, also known as a factor market, is any place where households sell one of the four production factors. If you don't remember what those are, they are land, labor, capital, and entrepreneurship. And this is where households sell one of those factors to businesses. When talking about the actual diagram, you're going to have the businesses to the left and the households to the right. I will draw that out. Ta-da! They have now been magically drawn. In the model, your factor market will go on top and your product market is going to go underneath. And just like that, they have been drawn. Okay, so let me give you a quick rundown of what this diagram is. This diagram is basically just going to explain how money, products, and resources flow in the economy. So the first thing, the businesses, they supply goods and services to the product market. And then the consumers in the households, they want to buy those goods and services, and they buy them at none other than product market. And next, the households, they basically supply like the four factors of production to the factor markets. I wrote resources there because the four factors of production are basically just resources. And so next, the businesses, they want these resources and they buy them from the factor market. And now you think we're done, right? Because we just have a circle? No. There is money that goes in the opposite direction, which I will diagram in a second. But first, let me explain it. So let's start here. Obviously, these goods and services cost money, so the households are going to give consumer spending, to the product market. And then when the businesses sell these goods and services, they get money, which is basically in the form of revenue. Next is the businesses paying for the resources, and this is called the costs of production. Okay, we got that done. And so now the next thing is going to be the factor market buying these resources, which will provide an income to the households. Okay, you'd think that we've got to be done by now, right? Because we have two circles, basically. But we're not, because we still haven't accounted for the public sector, which in a condensed form is everything in the economy that the government controls. So the public sector is just going to go straight in the middle. And it's just going to be government because it's everything that the government controls. So the government buys goods and services from the product market. An example of these could be fire trucks, police cars, stuff like that. And then the payment for those goods and services is known as government spending. And then the government buys resources from the factor market, and this can be like police officers, teachers, firefighters, just like people, labor, and stuff like that. And once again, the payment for those resources is known as government spending. And then the public goods are stuff like roads, and just like public goods, basically. And the government supplies these to both businesses and households. The government also gives households welfare to decrease poverty on a bigger scale. And the government also gives businesses subsidies to help the business be more efficient and increase output. These two, subsidies and welfare, are known as transfer payments, which is basically government payments to either households or businesses, and these are designed to meet a specific objective. For example, here we have increasing productivity and output. And now taxes are the main way that the government can afford these subsidies, public goods, and welfare. And the households and businesses both pay taxes to the government. I hope you enjoyed my video today. It was maybe a bit boring because it had a lot of information, but I had fun making it.